You can have the perfect setup, the right stock, literally everything lining up, and still lose in trading. The reason why is because you self-sabotage yourself. You either overtrade, you have FOMO, you size up too big and make emotional mistakes, and it's all because you can't control yourself and your emotions. This episode is the one that changes everything, because I'm not talking about just trading tactics. I'm talking about how to implement execution and have the right psychology and mindset while you're actually in a trade. Because at the end of the day, you have to execute your trades to make money. You could be the best technical analysis trader in the world, but you don't actually trade the stocks the correct way because you let yourself sabotage yourself. And I've personally been there. I've been in trades where I did literally everything right. I had the right entry. I knew exactly where my take profits was, and I still took profits way too early, or I got stopped out right away because I self-sabotaged. I second-guessed the trade. I was sized up too big. I didn't have a clear mind going into the day. And the moment I actually started to have discipline and be able to stick to my plan is the moment everything changed in my trading. I used to be unprofitable for 2 years because of the fact that I was not able to A, accept losses, and B, stick to my plan and have the discipline to know and do the things that I know I should be doing instead of the things that my brain was trying to kind of force me to do and trick me. And that's the thing with trading. It's not like anything we've learned outside. You have to accept how to lose. You have to be the best loser. The best losers are the ones who are able to make the most money and have the biggest wins because they're able to accept the fact that they're wrong, and they're able to accept the fact that they're wrong very quickly, which is super, super important. And I've had weeks where I've made more than some people's yearly salaries, and it's not because I got lucky. It's because I had the right mindset, I had the right execution, and I was able to stick to my game plan and trust it, which is the most important part. A lot of people have game plans, but they don't trust it when push comes to shove, and then they end up getting out too early or holding on for too long and then just end up praying that the position goes in their way. And if that sounds like you, this episode is literally going to change everything. The first thing you need to do as a trader is have a mindset shift. You need to start thinking like a profitable trader. And this means you don't have to be right every single time, because trading is not about winning every time. It's actually about following your plan and having good habits. Now, the thing that a lot of people confuse is they think a trade that they won money on or they made money on is one that was a quote unquote good trade. Now, what if I tell you that you could have a trade that was something that made you money, but you still had a bad trade and you didn't do the right thing? You would probably tell me, no, that doesn't make sense because I made money off that trade. Now, this is where a lot of the bad habits get reinforced in beginner traders and even traders that have been doing this for years. And the moment you start building bad habits as a trader, it's almost impossible to get you off those bad habits. It's literally like someone just starting to take drugs and not knowing how to get off of them. That's how bad habits and how strong your mental in trading is and how hard it is to get out of those bad habits. Now, the right way to think about trading is if you followed your plan, if you followed your rules, and if you followed your risk management, that is a good trade. So the trade being good or bad all comes down to if you followed the plan that you had outlined for the trade. Did you follow your conviction? Did you follow your stop loss? Did you take profits when you planned to take profits, or did you take it too early? Now you know if the plan and the trade was actually good, or if you just got lucky on the trade and ended up hoping and praying to make money and actually ended up happening. But usually that's not going to be the right way to go about it, because what's going to happen is those bad habits are going to compound. You're going to continue to make the same mistakes. You're going to average down. You're going to hold and pray for things to recover. Maybe once or twice it's going to pay off, but then a few trades down the line, what's going to happen is you're either going to blow your account or have one massive loss and then just spiral out of control with your emotions. So just remember, the first thing you want to do is shift your mindset to rewarding yourself based on the fact that you stuck to your plan and not the fact that you made money as a trader. The biggest shift that I ever had was I stopped trying to make money fast, and I was just focusing and practicing on making good habits and trading the right way, following my plan, having an actual plan before I take the trade, and then following that, having the discipline to continue to do the same thing day in and day out, even when I got super aggravated, right? Sometimes you're going to get annoyed. Sometimes you're going to get on tilt. Sometimes the markets are not going to be in your favor, but it's about learning how to control that. Now, it's not all going to come right away, but this is something you have have to work at. You don't just get amazing as a trader overnight. What happens is you have all these little stepping stones that end up making you the trader that you are in the future, which is a profitable trader, one that is able to have a proper risk management plan, and one that is able to actually follow through on the things that they said they were going to do, whether that be journaling, actually taking the right trades you know you should be taking, or having the discipline to stick to it all. Now, these are the biggest psychology traps that a lot of traders fall into. I've been a victim of some of these, and still 6 years into trading, I still make some of these same mistakes, but this is the biggest one that I really recommend everyone start to avoid. So the first one is overtrading. Overtrading comes usually from boredom or from the fact that you're looking to make money very quickly. So what ends up happening is you really want to make a ton of money and you think that more trades equals more profits, when actually that's incorrect. And if anything, it could be far from the truth. A lot of times, the less trades you take, the more money you can make because you're taking the most high quality setups and the most high quality trades, but it's all about holding those runners for a long period of time. Now, here's something that I started implementing in my trading that I do for myself that gets me out of overtrading. So the first thing that I do is I have a checklist. So this checklist is basically a tool that I use that I have to check every single box. And as long as that checks, I can now enter the trade. So there needs to be, for example, momentum. The stock needs to be in a strong sector. The market needs to be above the moving averages if I'm looking to long. And there has to be some sort of parameters to make me enter that trade. Now, a lot of the times, obviously, in my brain, I already have my checklist kind of, mapped out, and the setups that I'm looking at, I already kind of know them. You always want to have some sort of checklist, and you kind of want to get an idea of the parameters that you want on the actual setup that you're going to trade. Now, the second thing that I do is actually has nothing to do with trading. So what I do is step away from the screens. So at 11:30, 12 o'clock, which for me Eastern time is lunchtime, I step away from the screens. The reason why is because usually during these hours, I realize that volume is very low, and these are the times where I take the worst trades. Why? Because a lot of times I'm over trading, or I'm just taking boredom trades, right? Like I'm bored during the day, I'm bored during lunch hours, and I just end up taking a random trade. Now, what I usually do is step away during these low volume hours and these low probability hours, and I come back during the higher probability hours, which are around 2 to 4 o'clock or 3 to 4 o'clock, which is known as power hour, where you have a lot of the volume that was in the morning come back into the markets. And I think this basically makes it a lot easier for me to stay out of the markets when the markets aren't moving much, and only stay in the best positions and make sure that A, I have my checklist, and B, I'm not over trading during low volume hours. The next mistake is revenge trading. This is probably going to be one of the worst ones that you could spiral into, because if you revenge trade, what's going to happen is you're going to be going down from, let's say, 5 or 10% in your account all the way down to 20, 30, 50%, and maybe even 100% of your account blown just because you're trying to make back the previous loss. Now, the issue that a lot of people have, especially in this society right now, is that we're all thinking so short term. Every single thing that we think about is, okay, I want to make money today. I want to make money tomorrow, right? No one thinks about a week out, a month out, a year out, right? If you can start shifting your mindset as a trader to think far out and long term, what's going to end up happening is you'll chalk up a 5% loss and say that it's going to take me about a week to make that back or 2 weeks to make that back, right? But what's going to happen is you're going to make it back the right way. And then one loss or two losses are not going to blow up your whole account. No one has ever blown up their whole account by managing their risk. People blow up their account by over risking, by revenge trading, by averaging down on bad positions and holding and praying. But no one has ever blown up their account by managing your risk. Imagine your risk is 1% per trade. You'd have to lose 100 trades in a row to blow up your account. Now, the chances of that happening are probably almost zero, right? I don't think anyone is really able to lose 100 trades in a row. It would be very hard to do that. And that is the importance of risk management. The third mistake is oversizing and averaging down on your positions. Oversizing is going to be a killer because what happens is your emotions are going to get to you as a trader. Now, I'm not saying there isn't a right time to size up on your positions and get to that bigger size and scale up your account. I've done it myself. I've seen numerous other traders do it themselves as well. And that's at the end of the day, the whole goal of trading. You want to be able to compound, but we want to do it the correct way. We don't want to go from having a, let's say, $1,000 position all the way to a $2,000 position and double our position sizing right away. What I like to do is slowly, incrementally add size into my position as long as I'm comfortable myself as a trader. Now, every single trader is different. Everyone's going to have a different personality and everyone's going to have a different risk threshold. You might not be able to risk more than $1,000 without your heart starting to race or without you feeling like you're not going to be able to hold your position for a long period of time, but someone else might have a $10,000 or $100,000 capability for that risk. So understand yourself as a trader, understand what risk you're comfortable with, and then slowly start to build up instead of oversizing right away. A lot of people will have one good green week or one good green day, and then they'll think that every single week or every single day, they're going to be able to make the same money. So they size up. And what happens? They get over emotional. They end up averaging down. They end up blowing up their accounts. Now, averaging down is a whole different beast in itself. This is something I never recommend anyone to do on options, but if you're going to do it on shares, there is a right time to add it into your position as you go up. But averaging down on options is very, very risky. The reason why is because options could go to zero, right? Options can go to zero because some of options do not have inherent and intrinsic value since they're out the money. So what can happen is the contract isn't in the money. It'll go towards zero near expiration. And what will end up happening is your whole portfolio will literally blow up in one trade. Now, this has happened to me before, and I've seen countless of other traders do this as well. So this is why I'm telling you to never average down into your options position. Only if you're an experienced trader and you have the discipline to be able to actually cut the position in case it goes against you. Now, the last psychology trap that I want to talk about is FOMO and chasing stocks. This one is a very bad habit that I personally still deal with as well. It's almost impossible not to get FOMO. FOMO is probably one of the hardest emotions to kind of lock away because everyone has the fear of missing out. Everyone is scared of missing out on gains. When you see other people make money, you want to make money as well. So you're always looking to get into a new position. Now, obviously, your goal should not be to chase, and there's a good time to take stocks that have momentum, and there's a bad time to chase stocks when they've already made their move. Now, what I like to use is the 8 EMA for my trades. This is going to be the 8 exponential moving average, or you could use any other moving average as well. Now, a trick that I've learned not to chase trades is to actually use the moving averages to give me an idea of how extended a stock is. So what I'll use is the average daily range of a stock. So for example, let's say the average daily range of a stock is 5%. If the stock is more than double the ADR extended from the daily 8 EMA, I will not trade the stock. So that means if it's 10% away from the 8 EMA with the 5% ADR, that's double the ADR away from the daily 8 EMA, meaning to me, it's an extended stock and I don't want to trade it. Now, ideally, the closest a stock is to the daily moving averages, the better it is and the more likely it is that you're not chasing the trade. That is something that you should do and some rules that you should create to make sure that you don't FOMO into a trade. So just like everything else we talked about, these are things you should create for yourself. Rules. You should have rules in place to keep you in check, especially if you can't keep yourself in check, right? If you need someone to push you, if you need a little push, write things down and have them in front of you as you're trading. This is something that has helped me myself. I'm the same way as you guys, right? Don't think I'm anyone special. I made the same mistakes when I was first starting. I was very much struggling with being able to have discipline, not average down. These are all things I did when I first started, and I'm sure a lot of other traders that are successful now did the same thing. So just keep that in mind. Everyone could change. You have to put the work in to make sure that you're building the right habits and actually becoming the trader that you know you can become. Let me give you my 3 core rules that I live by. Rule number 1 is fix your size. The biggest issue that a lot of traders have is they're oversized and they don't have the emotional capability to be able to trade with the size that they're trading. They get too nervous. They ended up having their heart beating super fast while they're in a trade. These are all things that are going to affect you negatively and are going to take away from your plan and make you super emotional. That way you're either going to be, not being able to accept the loss or taking profits too early. These are never good things that are going to come from being sized too big. Rule 2 is have a plan before you enter a trade. If you don't have a plan for the trade, if you don't know A, where you're going to exit the trade, and B, where you're going to enter, then you don't really know what you're doing in the trade, and you're most likely gambling because you're hoping for something to happen without having a correct exit strategy. So what happens if you get into the trade and it doesn't go your way? What are you going to do? You have to know what you're going to do when the time comes that the trade is going to go against you, because that is going to happen, and it's going to happen a lot as a trader. That's the thing that many don't understand when they're first starting to trade. They think that they're always going to be right and it's all about being right all the time. No, it's actually the opposite. It's about being wrong very, very quickly. And rule 3 is going to be review every single night. Make sure to journal your trades. Make sure to review your thoughts. These are things that not many people focus on. You want to focus on your thoughts and your mental clarity as a trader. Think about the things that you were thinking of during the trading day. Were you lucid? Were you thinking of the right stuff? Were you thinking thinking about getting rich quick, where you're thinking about your risk, these are all things you can journal down and have a deeper understanding of where your mindset is during the trading day. This is how you're going to rewire your bad habits. This is how you are going to win. Today, here's how I manage my risk. Simple, clean, and no guesswork. Never risk more than 5% per trade. The reason why is because if you're full port into a trade and the stock gaps down, you're now going to lose more than 50% of your portfolio. So I like to make sure I'm not over leveraged too much during the nighttime. Size small if the markets aren't in your favor. If the markets are a little bit harder, it's not a bad thing to size smaller. A lot of people make it a competition of who could trade the hardest markets, but we're all here to make money. Why would you be throwing money into a furnace if the furnace is not going to be giving you money? It's going to be burning your money. So we want to lower our size, slow our roll, and make sure that we're using smaller size for our trades when the markets aren't that good. And when the markets are great for our strategy and we're making a ton of money, we could size up and use our 5% position sizing. Rule 3 is add only when in profit. Never average down on your positions. The moment you average down on your positions, especially with options, what's going to happen is you're going to build terrible habits that are going to be reinforced. And what you're going to think to yourself is every single time I average down, eventually I'll win. But what happens if it goes to 0 and you blow up your whole account? Never average down. Always measure my risk before I take a trade. So I always want to know how much I'm risking before I take a trade. So if the stop loss hits, how much money am I going to lose? The reason why this is important is because now in my head, I already know what my max loss is. So if I hit a $2,000 loss, I'm not caught off guard that I'm down $2,000. I already knew off the bat that that's going to be my risk. I can lose $2,000 on this trade and I won't bat an eye because I already knew that was my risk. And last but not least, a weekly review. I always like to go over the trades that I took, see what worked, see what didn't work, and how I can improve my trading. Because even after years of trading, there's always more to learn, there's always more to improve, and there's always more to get better on. This is what built my 7-figure account. Not chasing, not gambling, not relying on call outs and stuff like that, relying on my own analysis and relying on myself as a trader to make the right decisions when the setups are presented. If you made it to the end of the series, I want to say something most people won't. You're already ahead. And it's not because you watched some videos, it's because you learned what the 90% of traders will never take the time to learn. In this back to basics series, I walked you through the exact framework that I personally use to go from a confused trader that didn't know what he was doing to someone who's now able to build a 7-figure portfolio. In episode 1, we covered how to find the right stocks using levels, price action, and trends. In episode 2, I showed you how to read volume to confirm your breakouts and how to use a breakout swing strategy. And today we went deep into psychology and risk, one of the main reasons that most traders fail. If this series opened your eyes, do me a favor, go rewatch all the other videos. I linked them down below. Bookmark them, take notes, study, because that is literally the only foundation you're going to need to become a successful trader. Thank you so much for sticking this far, and I'll see you guys in the next video. Bye.